Hi guys, welcome to this channel. In today's video, we are going to be learning the advanced way of taking advantage of any trending market. So, to do this, we are going to be following these 4 simple steps. Number 1, trend identification. 2, identifying the price movement. 3, swing points. 4, important reversal candlestick pattern. After which, we will combine the information above to develop an advanced trend trading strategy with an edge over the market. Before we proceed, welcome once again. If you are new to this channel, consider subscribing. Don't forget to turn on the notification bell to get notified each time I release a new video, just like this one. Alright, trend identification. Trend identification will be easier if we first understand what a trending market is. So, what does it mean when traders say that the market is trending? Simply put, a trending market is when the market price movement has a defined direction to the upward or to the downward side. The upward direction of price movement is known as the uptrend, while the downward direction is known as the downtrend. It is important to note that the price do not move straight to the upside or straight way to the downside. Rather, the price moves in swings. So, let's move to the trend identification now. Now we know that we have 2 different types of trend, which is the uptrending market and the downtrending market. The next thing is to know how to identify them in the chart. We are going to start with an uptrending market. You already know by now that the price moves in swings. So, an uptrending market simply keeps its recent swing points higher than the previous swing points, known as swing highs or swing lows. It could also be called higher highs and higher lows. The first swing point here is the swing high 1 or higher high 1. The second swing point is the swing low 1 or higher low 1. The third swing point is the swing high 2 or higher high 2. While the fourth swing point is known as the swing low 2 or higher low 2. In this price action here, the swing point 4 is the recent swing point, which is higher than the previous swing point 2, and also the swing point 3 is the recent swing point high, which is higher than the recent swing point 1, which is the higher high 1. Maintaining this sequence, we can see that if the price keeps its recent swing high higher than the previous one, the price will keep pushing to the upside, which is exactly the definition of a trending market, to the upside. So, understanding this, we are going to dive into the next trend, which is a downtrend. Now, a downtrending market keeps its recent swing points lower than the previous ones, and the price will keep moving to the downside as long as the current swing point is lower than the previous ones. Observe that the first swing point here is the swing low 1 or lower low 1. The second swing point is the swing high 1 or the lower high 1. The third swing point is the swing low 2 or the lower low 2, while the fourth swing point is the swing high 2 or the lower high 2. Now, we can clearly see that the recent swing point, which is this swing high 2 or the lower high 2, is lower than the swing high 1 or the lower high 1. And the swing low 2 or lower low 2 is lower than the previous swing low, which is the swing low 1 or lower low 1. If the price keeps moving in this sequence, the price will continue to move to the downside, known as the downtrend. Now we know the different types of trend. It is important to see a clear example of both a downtrend and uptrend in the chart. Alright, this is a clear chart example of an uptrending market on Euro USD. Now, if you look carefully, you will discover that the price moves in swings. So, we have the swing point 1, swing point 2, swing point 3, swing point 4, swing point 5, swing point 6, swing point 7, and swing point 8. The first swing point, which is the swing high 1, the second swing point, which is the swing low 1, the third swing point, which is the swing high 2, the fourth swing point, which is the swing low 2, then the fifth swing point, which is the swing high 3, the sixth swing point, which is the swing low 3, finally the seventh swing point, which is the swing high 4, then the eighth swing point, which is the swing low 4. Okay, then we have about 4 swing points. Okay, swing point to the upside, then we have 4 swing points to the downside, which is 4 swing highs and 4 swing lows. Okay, so if you are observant, you will notice that the current swing high, which is the swing high 4, is higher than the previous swing high, which is swing high 3. And the swing high 3 is higher than swing high 2, which is higher than swing high 1. So we still have the same thing. Looking at the current swing low, which is the swing low 4, higher than swing low 3, which is higher than the swing low 2, and also higher than the swing low 1. Maintaining our definition that if the price keeps its recent swing high or swing lows higher than the previous ones, the price will keep trending to the upside. The reverse is the case when it comes to a downtrend. So, this is a clear example of a downtrending market using the same Euro USD. Now, we already know that the price moves in swings, and as you can see, this current price action is trending to the downside as it keeps making those higher highs and higher lows. So we have about 10 swing points here, which is the first one, which is swing low 1. We have the swing low 2. We have the swing low 3. We have the swing low 4 and the swing low 5. Then we also have the swing high 1, swing high 2, swing high 3, swing high 4, and the swing high 5. So, if you pay close attention to this price action, you will notice that the recent swing high, which is the swing high 5, is lower than the previous swing high, which is the swing high 4. The swing high 4 is lower than the previous swing high, which is swing high 3. The swing high 3 is also lower than the swing high 2, which is lower than the swing high 1. So the reverse is the case when we talk about the swing lows. The recent swing low, which is swing low 5, is lower than the previous swing low, which is swing low 4, which is lower than swing low 3. Swing low 3 is lower than the swing low 2. And finally, swing low 2 is lower than the swing low 1. Maintaining our definition of a downtrend that keeps its recent swing low lower than the previous ones, or swing high lower than the previous one. And this is simply a clear example of a downtrending market. Understanding the price movement. So, the price moves in two different phases. We have the impulsive phase and we have the corrective phase. Now, if the price is trending to the upside, the massive bullish movement to the upside is known as the impulsive phase, while the low momentum corrective movement is known as the corrective phase. And these impulsive moves and corrective moves create those swing highs and swing lows, which bring about the trending market. So, if you look at this chart example, this is an uptrending market. So, in this trend, you can see that the first swing high is created by an impulsive move. Then the second movement, which is the swing low, first swing low, is created in a corrective way. The next is an impulsive movement. The one that follows is a pullback, created another massive impulsive movement to the upside. Then you have another pullback before another impulsive move. Then finally a pullback that has created another impulsive move to the upside. So this is how the price keeps moving in an impulsive movement and corrective movement. Then the reverse is the case in a downtrend. We have the first swing low created by an impulsive move followed by a pullback. Then another impulsive move to the downside followed by a corrective movement. Then an impulsive move to the downside followed by a corrective move to the upside that gives birth to the next impulsive move, then another pullback. We now have the last impulsive move before this pullback. So as the price keeps going to the downside, it keeps creating those swings, which is as a result of impulsive moves and pullbacks in a price action. So understanding this is going to help us take advantage of a trading market and make the right entry at the right point. In the quick tips section, we are going to see the important role these impulsive moves and pullbacks plays. So guys, so far we have been doing well, scaling down this particular journey. So if you love this content so far, please like this video and leave a comment on the next video you want me to create or next strategy you want me to create. If you are yet to subscribe, smash that red subscribe button for me and also turn on the notification bell to get notified each time I release a new video, just like this. So we go to the swing point. By now, we already know that the price moves in swings, and we also know what a swing actually means. So in this section, we are interested in understanding different types of swings and how to use this information to our advantage. There are two basic types of swings: the valid swing points and invalid swing points. The valid swing point is a swing point with at least 3 healthy candlesticks. In other hands, an invalid swing point is a swing point with less than 3 healthy candlesticks. Before we continue with the identification of valid and invalid swing points, it is important to know what a healthy candlestick look like. Healthy candlestick here simply means that the opening and closing of the candlestick should have a significant level of price gap. The candlestick body should be greater than the wicks in size. The formation of 3 or more healthy candlesticks in a swing point will create some significant level of price distance in the direction of the price. So, if the price goes up by creating 3 or more healthy bullish candles in every swing point, each of these swing points is called a valid swing top. In other hands, if the price drops by creating 3 or more bearish candles in every swing point, each of the swing points is called a valid swing bottom or swing low. The same thing is applicable when the price is trending to the downside. The invalid swing point is the opposite of a valid swing point. Once there is no clear distance between the opening and the closing of a candlestick, or the body equals the wick or even smaller than the wick. So, let's now go to the chart to identify these valid and invalid swing points. So in this chart example, I'm going to be sharing with you the valid swing points and invalid swing points. Don't worry about it. In the quick tips section, we are going to see the important role they play and how to use them properly. Now, looking at this chart, you can see that after the first impulsive move to the upside, creating the first swing high, we had a retracement or the corrective move to the downside. And in this correction, we have about 4 bearish healthy candlesticks. So, this makes this swing low or the second swing point a valid swing bottom. Alright, so which gave birth to another impulsive move. So, look at the fifth swing point here in this chart, which is the swing high 3. After that impulsive move that created the swing high 3, we have a pullback. And in that pullback, we had about 3 healthy bearish candlesticks that gave birth to the next impulsive move. And that swing low right there is a valid swing bottom or swing low. Now, using a downtrend chart example, you can see that the first corrective movement that created the first swing high, the swing high there was established by 4 healthy bullish candlesticks that gave birth to this massive drop to the downside, which after we discover another corrective movement to the upside, giving us the swing high 3 with about 4 healthy bullish candles that gave birth to another massive drop to the downside. Then we are going to see an example of invalid swing points. Now, in this chart example, you can clearly see that the price tried creating the next swing point right here, but failed by creating 3 unhealthy bearish candlesticks. Then, after that, the price actually tried to push up again and failed again, created another invalid swing point, having 2 bearish candle with 1 unhealthy candlesticks. Then the price also failed to create the next higher highs. which actually signals a change of trend to the downside. So, looking at this swing low right here, with 3 unhealthy bearish candlesticks, is an invalid swing low because there is no clear significant price difference from the swing high right there and the swing low created. The same happened to the next invalid swing low, which had about 3 bearish candles with healthy candle in the middle, created another swing low with no significant price distance, which is actually a signal that the price is about to change to the downside. So if you have been taking this trade all this while, when you start discovering some invalid swing lows forming, you should start exiting your trade. We're also going to see how to leverage on this, both on quick tips and when we are going to be putting all our price action together to create a winning strategy. So that's for valid and invalid swings. Now, the fourth step, important reversal candlestick pattern. We have the pin bar candlestick pattern, which is the first one here. The bullish pin bar, known as the hammer, and the bearish pin bar, known as the shooting star. So, in this strategy, we are going to be looking for hammer, invalid swing lows for possible trade signal to go long. Also, the shooting star as swing highs for possible shorting opportunities. The second candlestick pattern we are going to be looking at is the engulfing bar candlestick pattern. We have the bullish engulfing and the bearish engulfing. We are going to be looking for the bullish engulfing in a swing low for possible signal to go long. Also, the bearish engulfing candlestick pattern at valid swing highs for possible shorting opportunities. The third candlestick pattern we are going to be looking at is the tweezers. We have the tweezer top and tweezer bottom. We are going to be looking for tweezer top in a valid swing high for possible trade signal to go short, the tweezer bottom in a valid swing low to go long. The last in this candlestick section is the inside bar candlestick pattern, the bullish inside bar and the bearish inside bar. We are going to be looking for the bullish inside bar in a valid swing low to go long, while the bearish inside bar in a valid swing high to go short. Now that we have all the information we need, we can now go ahead to create a system that will give us an edge over the market and the flexibility of maximizing profits and minimizing our losses, which is the bedrock of being a consistent, profitable trader. So, if you are ready, I am ready. Let's dive into it. Before we go into the strategy section, these are some quick tips for you. Never trade this strategy in a ranging market, rather a trending market. Never enter a short or long positions when the price is in corrective phase. Always identify valid swings to validate your entry. And finally, always wait for bullish or bearish reversal candlestick to form at the swing point before making entry. Welcome to the strategy section. If you have been watching this video till now, congratulations, because this might be the game changer for you. First, we are to identify the trend. If you look after the corrective move to the upside, we formed the first swing high, which gave birth to the next swing low, then another swing high before the swing low. So when you had your first swing high, Then the corrective move to the downside, giving us the first swing low, then another swing high which is lower than the previous swing high, then gave birth to another swing low which is lower than the previous swing low. Our trend is confirmed to be a downtrend. After which we are going to be looking for corrective move to the upside for us to start looking for signals to make entry for a short. Now, if you look at the corrective movement, you can see that the corrective movement created a valid swing high by having about 4 to 5 healthy candlesticks. Now, these healthy bullish candlesticks actually confirmed our swing as a valid swing top. Now, the fourth thing we are going to be doing is to identify a candlestick pattern which should be a bearish reversal candlestick pattern at that swing high for us to make entries. Now, if you look at that swing high, you can see that we had the first candlestick pattern right there, which is the inside bar candlestick pattern, followed by another bearish candlestick pattern, which is shooting star at that position, giving us an opportunity to enter this market. Now, after the close of the shooting star right here, we are going to go short, and our stop loss should be above the wick or the swing high, while our TP should be between 1:2, 1:3, 1:4, or 1:5. So that's how to use this strategy. Remember, first, we identify the trend, confirming this as a downtrend. Then we wait to see a corrective move to the upside, which after the corrective move, we check inside the corrective move to see if we have 2, 3, or 4 healthy bullish candlesticks. After identifying the bullish candlesticks, we also confirm this as a valid swing high. Then we look for candlestick for entry, which is our bearish reversal candlesticks, the shooting star. Then at the close of that shooting star, we made entry, our stop loss above the swing high, and our TP 1:2, 1:3, 1:4, or 1:5. Remember, in this strategy, we are not expected to use 1:1 because we are looking for a strategy that will give us an edge over the market and the flexibility to maximize our profits whenever we are right with our speculations. So this is the first example. We go to the next example. Here is the second example of the strategy. First, trend identification. If you look at this price action, you can see that the price created the first swing high, then followed by a swing low, after which the price created another swing high, followed by another swing low. So at this point, we confirm the bullish movement. Now, our bullish trend have been confirmed because the second swing high here is higher than the first swing high. Also, the second swing low is higher than the first swing low, confirming our uptrend. So the next thing we are going to be looking for is the face of the market. So we are going to be looking for corrective face to give us a valid swing low for us to make entry. Now, after this impulsive movement is followed by a corrective move to the downside. And inside this corrective move, we discovered about 3 healthy candlesticks, giving us the valid swing low, which we are looking for. Now, in this valid swing low, we had the inside bar candlestick pattern right there, giving us opportunity to enter this trade at the close of that candlestick to the upside. Then we simply set our stop loss below the swing low and our TP 1:2, 3, 4, or 5. Now, remember one interesting thing about this strategy is that it helps you set a tight stop loss, because our goal using this strategy is to minimize our losses and maximize our profit, which is the secret of every profitable trader. So, this is the next example on USD JPY. If you look at this price action, the price first created the first swing low, which after the swing low gave birth to the next swing high. And after the swing high, we had the second swing low, followed by the corrective move that gave us the second swing high. So after this second swing high, our trend is confirmed to be a downtrend. So the next thing we are going to be looking at is the face. So we wait for another impulsive move. Then after that impulsive move, we also see corrective phase of the price action. Then the corrective phase is confirmed, giving us the next swing high, which is our target. Now we look into that corrective phase and we observe we have more than 3 bullish candlesticks healthy right there. Then after it, we look into the swing high to see if there is any reversal candlestick pattern to the downside. Now we discovered a bearish engulfing candlestick pattern right there. So at the close of that candlestick pattern, we are going to go short, and our stop loss will be above the swing high. Our take profit will be times 2, 3, 4, or 5 of our stop loss, still giving us the room and flexibility of maximizing our profit and minimizing losses. So this is exactly how to take this strategy on any pair. Now we are done with this first trend trading strategy. It's time now for you to go ahead and backtest it in the chart and start making decent amount with it. As you're enjoying this one, do well to check back in few days time, because I will be modifying this strategy and add more confluences so as to help you take only quality trades, which will be made possible by the next strategy I will be sharing, which I call the advanced trend trading strategy.